Hey, it's Tony, CPA dude here. Quick disclaimer before we start. This is general education, not personalized tax advice. Talk with your own tax pro before you implement anything. If you're a high earner and you either own or want to own a short-term rental like an Airbnb or VRBO, this video is for you. In the next few minutes, I'm going to break down the so-called short-term rental loophole in plain English, show you who actually qualifies, and walk through a simple example of how people use it to legally wipe out tens of thousands in taxes and how they screw it up. Okay, so this is one of the most unique strategies out here because it works for a ton of people. So number one, it works for if you're working W-2, which is 95% of the population, works for business owners. This actually is about 5% of, oh my goodness, I can't write here. It works for about 5% of the population here. So owners. And then number three works for real estate investors on the side. So even though if you are doing other short terms, I'm sorry, long-term rentals, you can actually get some short-term rentals in and get yourself a benefit for you here. So those are going to be three people that you can go towards that will apply the strategy towards. And the key part here is what does short mean? So, what's the definition of short? So, how the IRS looks at it here is that it has to be 7 days, have an average of 7 days or less. So, what this would mean here is that you have to have your total days divided by your total stays. And this is what's going to be that number. As long as it's 7.0 or less, you'll win. Now, the second thing is you actually have to have this fancy thing called, what the IRS calls it is you have to have material participation. So fancy words, but tax codes always has fancy words for no reason. So there's seven different tests on this to meet it. And essentially what it boils down to is that you have to work. Like you can't just get benefits without having to work. What does meaning you have to work? Of these seven tests, my favorite ones that we have is 100 hours and no one works more than you. So you just have to prove out all the hours that you did 100, no one did more than you. The second one is you got 500 hours, and anyone can work more than work more than you. So this one's a little bit more tough because it's a lot of time, but it's an easy one. And then if you're going to come up to the wire and you're just watching, listening this at a later time, then number three is that you can have substantially subs. Oh my goodness, I'm just gonna go here, just write out quick here. Substantially performed all services. So pretty much you did all the work here. So you have to actually be doing stuff. So what are those things? Is that you're making decisions, you're managing guests, you're handling the cleaners, dealing with the calendar. Essentially you're just not gonna hand everything off to a property manager and disappear. So if you're a hands-off person, this strategy isn't for you. I tell our clients just strap in at least for the first year. You're gonna get a fat tax benefit. So work a little bit for what you have to do. So that's here. So now, I said who this works for. Now we're going to go into how the strategy works. So how does this strategy work and why is it so magical? So normally, generally speaking, that all real estate is equal as passive income, passive losses. So because of how the IRS has defined real estate, it means that if you buy like a long-term rental or mid-term rental, any losses generated from real estate, generally speaking, can't offset your W-2. There's a couple other things like the real estate professional status or the mom and pop deduction that would allow you to, but in this, 9 times out of 10, it doesn't work. So the crazy thing though is that short-term rentals have a specific loophole. And because these can actually be treated as active, how do you get active? Well, we went over that up here, where you have to have right here, you have the average stay of 7 days or less, and then you actually have material participation. So if you do that, it's considered active. And why does this matter so much? Is that active losses here? can offset active income. So right here, so if you have 100K in losses, but you have 200K in income, you only get taxed on 100K. Okay, so you can think about real estate like this. You got oil here, and that's real estate, right? You got water as your active income right here. The two do not mix, my friends. So what you want to do is that STRs can be water and water. These two do mix, it's a win. So what you want to do here is that you can actually offset all this here with your short-term rental loophole here. So essentially what this means in like plain English is that you can buy a property, you can do a cost segregation study, and you take a big chunk of depreciation in year one, and you'll show a large paper loss, and that can offset your actual income. So let's just run numbers here. It's always easier to just use an actual example. So say you buy a property for $600,000 here, through cost segregation, bonus depreciation, you can probably get, I generally say 20% value is land. So here you're down to about 480. And then I would say you can probably get, I'd say at least like 25% of this as bonus depreciation year one. So this would be 120K in year one that you can offset from your active income. So on 120K, that means you lost money for the IRS, lost, but you didn't actually lose, the actual 120K here. Is all you did was just create a paper loss and you're gonna use that to offset your active income. So then this is how you're gonna save. So let's just say you made, $150,000 from your W-2 job. Then you take this 120K loss, push it down here, you're only gonna pay taxes on 30,000 bucks. So this is where the magic happens. So that's the next part here. And then the last part here is just mistakes that will get you in trouble. So things that you do not want to do here is number one is that you don't track anything. You have to track. So you have to track what are you tracking? Your hours that you're working on a property. Do this like how an attorney would bill you every point one. So that means every 6 minutes, track it. Don't round to every 30 minutes or 1 hour. That's not going to be good. Also, you need to track your stays. If you're using Airbnb, they do have good reporting, but you have to track your stays. But if you have off-property stays, then that's going to matter. Number two is going to be if you have your property manager run everything. So you need to actually work because you have to have material participation. So at least just strap in for the first year. Like it's not going to be that bad. And also, you probably learn a lot more about just running your own business. And then right here, the last part I'll probably say that I see is probably like just doing your cost segs wrong or not being aware of it. So cost segregation study, it's a paid study. So generally speaking, I've seen them from like 1,500 to like 3,500 bucks, depending on the property. Your cost seg has to be a real one. There are some fake ones, not fake ones, but like they're like these computer generated ones that are not that good. Some are good if the data is there. Obviously, I just grab two, three quotes and see what's going to be the best one for you here. So those are mistakes that you want to be doing. All right, so here, I'm just going to wrap up an example for one of our actual clients here. So my boy Danny here, he made 260K of income, 260K of income, W-2. He was able to go buy a short-term rental and he bought an 800K purchase price. He was able actually, his was crazy. I was like, holy cow. Well, he did put a lot of money into, but with bonus depreciation and setting up, he was able to get a 350K loss. So on here, he paid zero in federal income taxes, and we had a carryover loss of over here of 90K for the next year. So like this, all he did was literally just go in, have an active job. He bought a short-term rental loophole, did the 7 days, had the material participation, ran the cost seg study, and he was able to save a ton in taxes that way. So this is just the power of it. So if you're a client person making, high six figures, all you have to do is really buy a short-term rental. Yes, it's not easier. It's not easy per se. I mean, if you want any type of money, it's not easy. But this is how you actually build wealth because we save about, on this side here, oops, 260K. And on here, that's about at least 55K in taxes. So on 55K of taxes, this is what he has extra in his pocket. Otherwise, he would just have to give this to the government. So that's what you really want to be aware of when you're doing short-term rental here. If you're a business owner, high income earner making at least $200,000 a year and you want to legally lower how much you pay in taxes, click the link below for a free tax strategy session. Here's what that'll look like. You can pick a time with my team, we'll look at your situation and plan around your tax goals, and then we can see how you're overpaying and find strategies like the short-term rental loophole that makes sense or other strategies that are aligned with your goals. If it's a fit, we'll talk about working together. If not, you'll still leave with a clearer plan than you came in with. We only open up a limited number of these sessions each week so the team can actually do the work. So if you're serious about keeping more of what you earn this year, grab a spot while there's still room.